Welcome to the Luxembourg Funcast.
Great to be here.
Today we're diving straight into the latest CSSF report. This is the one covering Luxembourg UCIs, the global picture as of the end of March 2025.
That's right, just released data.
And our goal, really, is to pull out what matters most for you, the legal, compliance, governance professionals out there. What are the regulatory takeaways? What are the compliance implications from this new data?
Exactly. We're essentially unpacking that official CSSF press release to see what it tells us about the state of play.
Okay, so let's start high level. The headlines seem to be a drop in assets for March.
Yes, quite a noticeable one. The report shows total net assets as of March 31st, 2025 at EUR 5,749.779 billion.
Okay, and how does that compare to the month before February?
Well, at the end of February, the figure was EUR 5,957.264 billion. So that's a drop of 3.48% just in March.
Wow, 3.48% in 1 month. That's pretty significant. It definitely makes you wonder about the immediate impact maybe on reporting investor comms.
For sure. A drop of that size, you're talking over 200 billion euros, needs a closer look.
So what did the CSSF say drove that contraction? Was it investors pulling money out?
Interestingly, no, not primarily. The CSSF breaks down that EUR 207.485 billion decrease. And there are actually positive net capital investments.
Oh, really?
Yeah, about EUR 16.319 billion came in. That's a positive inflow of 0.28%.
So money was still coming into Luxembourg funds overall.
That's right. But, and this is the key part, that inflow was completely swamped by negative market developments. The markets themselves accounted for a EUR 223.804 billion decrease. That's negative 3.76%.
Got it. So market performance was the much bigger story than investor flows in March. It really highlights how exposed these funds are to, well, global events.
Absolutely. External forces were definitely in the driving seat.
Okay, but 1 month is just a snapshot. How does this look if we zoom out a bit? What about the year-over-year picture?
That's a crucial point. Context matters, doesn't it? Over the last 12 months, so looking back from March 2025, total net assets actually grew.
Oh, okay. By how much?
By 4.82%. So despite that March dip, the longer-term trend for the year leading up to it was still positive growth.
Right. So for compliance teams, it's about balancing that short-term volatility against the underlying annual trend when assessing risk and stability, perhaps.
Precisely. You need both perspectives.
Makes sense. Now, the report also gives numbers on the UCIs themselves, the structures. What are the key figures there that, legal folks should probably note?
Well, there was a very slight dip in the total number of UCIs, down from 3,131 in February to 3,124 in March. Not a huge change.
Okay.
But what's always striking is the structure. Umbrella funds continue to dominate. We're looking at 2,066 umbrella entities.
And how many sub-funds within those?
A huge number. 12,461 sub-funds within those umbrellas.
Wow.
And then you add the 1,058 traditional standalone UCI structures. All told, that brings the total active fund units to 13,519.
13,500 active fund units. Just managing the documentation, the compliance, potential cross-liability issues in those umbrellas, that's a massive undertaking for legal and compliance teams.
It really is. The scale and complexity are significant.
Okay, let's circle back to those market developments you mentioned. The CSSF report explicitly links the March performance to specific global events, doesn't it?
It does, and that's quite insightful. It specifically calls out the impact of U.S. tariff announcements.
Ah, right. The ones targeting China, Canada, Mexico, steel, aluminum, the car sector.
Exactly. The report notes that these created a lot of confusion, undermined business and consumer confidence globally.
Yeah, I remember the uncertainty around that time.
And that led to rising concerns about trade tensions escalating, potentially hitting growth, and maybe even increasing the risk of a global recession, possibly led by the U.S., or even stagflation there.
So quite a ripple effect from those U.S. policy decisions impacting Luxembourg funds.
Definitely. But it wasn't all negative on the global stage, according to the report.
Oh, what else was going on?
Well, there was some positive news out of Europe. Germany announced significant investment plans, particularly in defense and infrastructure.
Okay, and that helped sentiment.
Apparently so. It led to a bit of a reassessment of economic forecasts for Europe, and quite significantly, it contributed to the euro strengthening against most other currencies.
Right, the strong euro. That's often a double-edged sword for funds, isn't it? Good for euro-based assets, but can hurt returns on foreign assets when translated back.
Precisely. And that played out in the fund category performance.
So let's get into that. How did equity UCIs fare amidst all this the tariffs, the strong euro?
Well, as you might expect with the market downturn, most equity UCI categories posted pretty substantial losses in March.
Even European equities, despite the better sentiment you mentioned?
Even European equities, yes, but the biggest hits were in U.S. equities.
Okay.
And that was made worse, as you just hinted, by the currency effect. The U.S. dollar weakened by nearly 4% against the euro during March.
Ouch. So that directly cut into the euro returns for funds holding U.S. stocks.
Exactly. But here's the counterpoint we touched on earlier. Despite these market losses, equity UCIs as a whole actually saw positive net capital investment. People were still putting money in.
Still buying into equities during the dip. Where were the inflows going?
The largest inflows were actually into European equities and also Eastern European equities.
Interesting. So investors were perhaps seeing opportunities there, despite the overall negative market performance. From a compliance angle, that divergence market losses but continued inflows really highlights the need for clear communication, doesn't it? Explaining why the fund performed as it did.
Absolutely. Transparency about the driver's market moves, currency effects, underlying flows is paramount.
Okay, what about the fixed income side? We had central banks moving or hinting at moves.
Yes, the backdrop was the ECB cutting rates by 25 basis points, which was widely expected. And the Fed in the U.S. held rates but signaled potential cuts later, citing growth worry.
Oh, but did monetary policy actually drive performance in March?
According to the CSSF report, not really. It suggests the tariff developments were actually the main performance drivers, more so than central bank actions.
Huh. So trade overshadowed rates. How did different bond categories perform?
Emerging market bonds got hit the hardest. That was linked to weaker growth expectations because of the U.S. tariffs, plus negative currency impacts for them.
Makes sense. And European bonds?
They also had negative returns. The report points to a steepening yield curve, possibly due to anticipation of increased long-term funding needs, maybe linked to those German investment plans. Credit spreads, however, remain pretty stable.
Okay. And investor flows in fixed income? Similar to equities.
Yes, actually. Fixed income UCIs also saw positive net capital investment overall in March.
Where did that money go? Safety place.
Seems like it. The biggest inflows by far were into EUR money market funds.
Right. A classic move to perceived safety and liquidity when markets get choppy. That's definitely something for compliance teams to note shifts in risk appetite showing up in the flows.
Exactly. It can signal potential changes in how investors want their assets allocated.
So a really complex picture across both equities and bonds. What about the more blended strategies, diversified UCIs, and funds of funds?
Similar story, really. Both categories saw negative market variation, reflecting the general downturn.
But did they still attract money?
They did. Both diversified UCIs and funds of funds reported positive net issues, so net inflows. Investors still seemed interested in those diversified approaches despite the volatility.
Which, from a governance perspective, probably reinforces the need to continuously check that those diversification strategies are robust and doing what they're supposed to do in changing markets.
Absolutely. Ensuring alignment with investor expectations and suitability is key.
Okay, let's shift gears slightly to the regulatory activity itself. The report lists registrations and deregistrations. What does that tell us?
Well, it's a direct window into the dynamism of the Luxembourg fund center, isn't it? And of course, the associated workload for regulatory and compliance functions.
So what were the numbers for March 2025?
In March, 9 new UCIs were registered on the official list.
Okay, across which types?
They included UCIs Part I funds under the 2010 law, some Part II UCIs, and also specialized investment funds, CEFs. The report actually names them individually.
And on the other side, deregistrations.
16 UCIs were removed from the list in March.
16 out, 9 in. So a net decrease there too.
Yes. And the deregistrations covered UCIs Part 1, Part 2, CIFs, and also a SACAR, the venture capital vehicle. Again, the specific names are listed.
Is there anything particularly noteworthy in those deregistration details?
There is one specific note the CSSF makes. For one of the deregistered UCI's Part I funds, Allianz Global Strategy Dynamic, it points out that its management company was actually authorized in another EU member state.
Ah, that's interesting. It highlights the cross-border nature of the business, doesn't it? And the importance of understanding the interplay between regulatory regimes.
Exactly. Managing funds across borders adds layers of complexity.
And for our listeners, these ins and outs registrations, deregistrations, they directly translate into work, right?
Yeah.
Launching a fund means intensive documentation, getting approvals, setting up compliance systems.
Absolutely. And winding one down or merging it involves navigating specific procedures, ensuring investors are properly informed, managing liquidations or transfers.
So this constant churn really underlines why legal, compliance, and governance professionals need to be constantly vigilant, keeping up with the rules, adapting processes.
Couldn't agree more. Governance bodies play a critical role overseeing these transitions, making sure everything is done by the book, protecting investors whether a fund is starting or ending.
Okay, let's try and bring this all together. Based on this deep dive into the March 2025 CSSF report, what are the sort of key takeaways for the legal, compliance, and governance experts listening?
Well, I think first, the report really hammers home how sensitive the Luxembourg UCI sector is to global events like those U.S. tariffs. Constant monitoring of the international economic and political landscape is clearly essential.
Right. Complacency isn't an option.
Second, the flow data seeing money move into money markets or into European equities despite losses gives real clues about investor sentiment and behavior. That's valuable intel for risk management and strategy. And finally, the registration and deregistration activity just confirms the dynamic nature of the industry here. It means the demands on regulatory and compliance resources are continuous and evolving.
It really paints a picture of an industry deeply connected to global forces, but also constantly reshaping itself internally. So maybe the final thought for our listeners is this. Given these market dynamics, the currency effects, the regulatory churn, what proactive measures should you, as legal, compliance, or governance professionals, be thinking about now to ensure Luxembourg funds remain stable, attractive, and, of course, compliant?
That's the key question to ponder.
Definitely something to think about. As we mentioned, the full CSS report has much more granular detail. You can find it on their website if you want to explore specifics for your own role.
It's worth a look.
Well, thank you for joining us on the Luxembourg Fundcast for this analysis.
My pleasure.